Good now, revolutionaries, and welcome to the Rise Up Morning.
The Rise Up Morning Show.
It is Wednesday. It's been a minute since I've been here, but it's the 5th of November. And that means that I get to watch one of my favorite movies of all time today and bully my wife into watching it as well. So, in honor of November the 5th, I'm really excited to have our new friend Andrew from Jito join us today. You might have heard us rambling and talking a little bit about this, setting Andrew up for success here. So honestly, I don't want to bogart too much of our time this morning with any ramblings. Will is somewhere in Japan doing that kind of stuff. If we have questions about the markets and how everything's going and setting up, please feel free. Just know that you're going to get the Alex analysis and not the Will analysis. So you might have to touch circle for that one. Sorry. But without further ado, Andrew, it is wonderful to have you. I'm very excited to get into the weeds of DeFi a little bit. We've kind of been working on the foundations for a very long time. I'm excited to level it up, and I'm stoked to have you. So for those who don't know you, who are you and what do you do?
Yeah, Alex, thanks for having me on, first off, and happy November 5th. I can think of no reason why it should be forgot. My name's Andrew. I work over at Jito Foundation. My formal title is contributor. We're still a very small team over at Foundation. I think we have 12 people. So there's a lot of wood to chop and a lot of water to carry. I think in many ways, this cycle, we've seen DeFi sort of professionalize. Jito in many ways still feels like an old school DeFi team in that everybody does a little bit of everything. In my case, I do a mixture of business development, of marketing, a lot of governance stuff, some operations stuff. So wherever anybody needs a hand, I tend to have my hands on that as well.
So not busy.
Yeah, that's really the impression I wanted to give. No, particularly as things start to sort of heat up in Solana block building land, just nonstop competition. We have very much a startup mindset, even though we're relatively well established. And so a lot of 14-hour days and that sort of thing.
Yeah, I want to actually touch on a little bit of the business stuff first before we get into the nitty gritty of all of the DeFi things, because you guys are you're in my favorite category of protocol, which is crypto protocol that makes revenue.
Yeah.
So that's exciting, but I actually didn't know that the team was that small. That's quite something. Has that been the case for a while, that you guys have been kind of running leaner like that? Because I imagine you guys are just like completely inundated.
Yeah. The short answer is yes. I think famously we've never fired or let anyone go. There was one person who left before TGE, but since the JTO token came out, everyone that's been brought on hasn't left. We're very, very circumspect about who we hire and sort of growing in a responsible and very measured way. I think anybody who's been in crypto long enough has seen the headline, consensus lays off 300 people or something like that. And I just don't think Jito is ever going to be in that position. We're a very strategic and tactical team overall, but that's just one facet of that, the fact that we stay lean and mean.
So I definitely want to hear your kind of overview of how you introduce Jito to new people. But I'm trying to start. I would really like to start asking people this one question. If in your personal life, someone doesn't know what you do for a living, how do you describe it to somebody?
Sure. Well, I think there are two simple answers. I can give like the more crypto native answer.
Sure.
So even somebody who's a relative beginner, but knows what a blockchain is, knows what staking is. But if I'm like trying to explain this to my wine aunt or something like that, I'd say that I help build software that lets people do high frequency trading on blockchains.
Okay.
And then my aunt might not know what high frequency trading is, and so we got to get that conversation. But
yes, that was my next question.
Yeah. So high frequency trading. If you're placing a trade on Robinhood and you're trying to buy a big chunk of Tesla or something. You put in a market buy order for 300 shares of Tesla, and that costs a chunk of money. A few seconds later, the shares will show up in your account. The price will have executed roughly at what the website quoted it at, and you're happy. You got your shares roughly at the price you thought you were going to get them at. Under the hood, though, what's happening is that order is being filled by these incredibly fast computer programs, these algorithms that are looking at the bid and ask spread. Somebody wants to buy Tesla at $300. Somebody wants to sell it at $299. And these algorithms are trying to fill in that gap as quickly as they can, buying and reselling incredibly quickly, often sub millisecond speeds, or sub 100 millisecond speeds more accurately. One way to think about it is market makers and algorithmic traders, they're just playing patty cake with the price of an asset at any given time. They're trying to move around it and capture very, very tiny spreads between the bid and the ask in order to make markets more efficient, but also scalp tiny amounts of profit on many, many thousands of trades.
So, okay, I want to drill down just a little bit here. So we've talked about kind of, 30,000 foot view, some of the concepts that you're covering here. And I want to touch on the idea of MEV because it's pretty prominently featured across your guys' protocol, especially with regards to, how your infrastructure is built. Can you kind of break down a little bit about, first of all, what is MEV? We've talked about it some, but really not more than just going into, kind of what does the acronym itself stand for and what's the basic idea. And I know as we're talking about like high frequency and we talk about the beauty of blockchain being able to add this much velocity to transactions rather than, getting hung up too much on processing time. And, obviously as Mert likes to say, latency, so obviously this is a big part of what you guys do. And since we're talking about facilitating a lot more, like I said, than just somewhere to stake, how have you guys approached that whole side? And I guess what is your philosophy on, protecting people from MEV related attacks and then obviously, using it for good?
Yeah, I think let's stick with the analogy of high frequency trading briefly. I think a lot of the contemporary MEV landscape, and MEV stands for maximal extractable value. We've sort of discussed internally the possibility of attempting to rebrand all of MEV. Extractable sounds bad, I think as the MEV landscape has evolved, particularly from the early days of Ethereum, where you'd have a transaction sitting in a mempool for 30 seconds, 45 seconds. There's a lot of trading around your order that can be done when you have transaction finality that lasts that long.
And sorry, by mempool, we're talking about kind of the waiting room, the transaction waiting room, as we're waiting for the transaction to get into a block and to get added to the chain.
I'm trying to see if I can bring up that Ethereum transaction visualizer.
Oh yeah, perfect.
It's so pretty.
There's a couple great ones.
Yeah. New version is being rebuilt, alas. But anyway, it's a great little animation that shows all of the transactions moving around on Ethereum as these little people who are waiting to get in onto a bus. Yeah, there it is. I actually got one of them working. So I'll drop it in the comments. I have to connect to YouTube. Alex, I'll send it to you. You can maybe share it. But the mempool is, so when you click transaction submission, on most blockchains, what happens is that your transaction is sent to the memory pool where it is going to wait until a validator organizes a block, fits it into a block, and submits that block to be validated by the rest of everybody else. And so here we've got a lot of people, these all represent transactions. Most of them are Tether transactions, which is kind of funny. And these are all coming in and getting packed into the buses on the far right that represent blocks. And so in the high frequency trading example with Robinhood, you're looking at finality that's very fast. The algorithms have to move incredibly quickly in order to try and capture a little bit of spread on your Tesla trade. In the case of Ethereum, which has 20-second block times, there's a lot of time for these algorithms to sort of look at the transactions, figure out how those transactions will impact price, and potentially trade around them. There's a famous one called the sandwich attack, in which the algorithm will place a trade both before and directly after your trade, sort of capturing a lot of the spread of the value. This is what's known as, I think, malicious MEV, where somebody just wants to get a good price on a trade. They're trading USDC for Ethereum, and because they set their slippage settings too high, they're going to get a lot of the value of that trade taken away from them. They're going to get worse execution. And if they set their slippage settings too high, they can get completely hosed, completely rinsed, just trying to place a single trade. That's much harder to do on blockchains like Solana, where there's much faster block time finality. I think Solana blocks are something like 500 milliseconds. And when you have that speed, you can still have sandwich attacks and other forms of malicious MEV, but mostly what you're looking at is arbitrage. There are going to be these algorithms. They're looking at how your trade, let's say you're, again, sticking with Tesla, now you're trading tokenized Tesla on the Solana blockchain. When you place that trade, that's going to slightly impact the price. And so an algorithm is going to look at the price on chain versus the price off chain and try and capture an arbitrage there. And so MEV is the value that's captured, I think, ultimately in high frequency arbitrage trading primarily. There's a couple edge cases like bots that rush really fast to try and liquidate DeFi lending positions and things like that. There's some more exotic fringe stuff, but 99% or more of the trading that you see, the MEV that you see on Solana is basically just arbitrage. People rebalancing price between decentralized exchange pools and rebalancing price between centralized exchange and decentralized exchange pools.
Yeah, and we've definitely covered, what to watch out for, especially if you're kind of, trying to trench it up a little bit and play around in the casino, because that's where we would see a lot more of the malicious side of MEV, whether we're talking about just, people getting front run because they don't know how, to set different things. It kind of, led to obviously a rise in the use of Telegram bots for trading, which of course presents, some solutions, but also not really, because, as you level that up, whoever's attacking can obviously level up to or use the exact same thing. We've talked a lot about, making sure that slippage is set, what slippage is, all that good stuff. So I want to explore a little bit more too about like the full scope of what you guys facilitate and offer as a platform, just because there's quite a bit, and it's definitely more on the complicated side, especially if, you've just, I want you to kind of imagine that we're talking to someone who is interested in expanding their understanding of DeFi and starting to experiment with something new. And, let's say for the sake of experience, what we've done so far is we're comfortable running our own wallet. We're comfortable connecting to a protocol. We've staked before and we've executed a swap before. We've had some of your friendly competitors and compatriots over at Marinade on before. We've talked about, exactly what happens on the back end when you stake, what happens on the front end when you stake. We've talked about swaps, of course, but I want to hear a little bit more about you guys, what you do beyond that, because you have, a little bit more of a robust ecosystem over there.
Yeah, I think there's a couple interesting things that you can do with Jito Soul that you can't really with MSOL right now.
And sorry, for context, when Andrew says Jito Soul, what we're talking about here is the liquid staking token that you receive in return for staking over there. So you would have raw Solana, it's staked with Jito. In return, you receive Jito Soul. And now, instead of just having your Soul locked, staking, doing stuff, doing its job, securing the network, you can now go off and explore and do other things kind of at the same time. So we're talking about liquid staking here, and then what you can do with the LST liquid staking token.
That's exactly right. So Jito Sol is the largest liquid staking token on Solana. We've got about 14 million Sol and TVL. Our closest competitor, I believe, is around 8 million. And crucially, in addition to being the largest in terms of, notional units, we're also the deepest liquidity. We have a lot of decentralized exchange liquidity that allows people to swap in and out of the LST very quickly. And this is going to be important for us, I think, as things like staked ETFs start coming onto market. That's something that a lot of the VanEck of the world are looking at, and why we think we've got a real shot to really bring a product like an LST to a sort of more stock brokerage based investor, and give them access to some of the stuff that you guys have been educating about for a while now. So I think the depth of liquidity is one place where Jito Sol really stands out. The size, just the sheer market capitalization of the thing is also where it stands out. But then there's a couple of things you can do. I think Jito is probably most well known for Jito Sol. It's very much our flagship product, but under the hood, there's a lot of other stuff going on that I think more advanced users could potentially check out. One of those things is, of course, the block engine. We help MEV arbitrageurs place the trades they need in order to make the markets on Solana more efficient. And a lot of the revenues of that, we call them Jito tips. Our arbitrageurs and the MEV folks, they pay Jito tips in order to have their transactions land. That's paid out to Jito Sol and a lot of other LSTs, in fact. So while it looks just like staked ether in many ways, and functionally that's how it's going to behave for a user. They stake their asset and they get their staking rewards. There is some interesting stuff happening under the hood that I think is really exciting in terms of how the yield is actually generated. But in terms of what you can do with the LST once you have it, I think one place to look would be the restaking product. We have a product called Tip Router. So when these MEV arbitrageurs, they pay out tips in order to have their transactions land, but those tips are sent to an account and then need to be distributed to all validators across all of Solana. This involves a pretty, math-intensive process of looking at the entire Solana chain's history, taking a snapshot of that activity, and then distributing the tips pro rata to everybody who validated certain transactions and who earned those tips. And the way we make sure that's done in a decentralized way is with a restaking network. So a bunch of node operators, much like a blockchain validator, they take that snapshot, they come to agreement on the contents of that snapshot, and then distribute that once a quorum has been met. And so that's a lot of big words, but in effect, what this means for your basic user is that you can take your staked Sol, your Jito Sol, and then restake it, stake it a second time to earn additional rewards for making sure that Tip Router runs right. You'd be delegating your Jito Sol to a vault operator who then delegates it to various node operators to make sure that the snapshot and distribution process runs properly. I think right now restaking is generating something like an additional 1% when you're looking at yields of 6-7% right now. It is a pretty significant yield uplift, and you get Renzo is one option. So Easy Sol is really just restaked Jito Sol under the hood, and I think if you're interested in those products, like an LST, thinking about a restaked LST is definitely an option if you're willing to take on the sort of stacked contract risk.
Okay, so there was a lot in there.
Yeah,
it's about half jargon. So I guess what would you say would be, so that was a great overview. I'm trying to kind of figure out how to make succinct what exactly like a new person would be doing from the user perspective. So if you were, let's pretend that you are walking to Jito for the first time.
Yes.
And you've got Sol. And like I said, you're familiar with the idea of staking. So what would the kind of simpler process be from that user perspective?
Yeah, we can walk through this on the website.
Set up to participate in like, let's say, the restaking, like you're talking about.
Yeah, it occurs to me we can walk through this on the website.
Let's do it.
Yeah.
If you want to actually, if you have one ready that you can walk through, you can do that. Otherwise, you can kind of coach me through one. Which would you?
Yeah, I can coach you. It's just going to be 3 or 4 clicks, really.
All right, let's do it. Let me share this. Now, all of you, first of all, I just want to give a quick shout out to everyone in the audience who's bearing with me today as I do all of the things. So there's several chats to monitor. I'm going to try to get all of these screen shares up so everybody can see everything, but I appreciate you guys giving me an extra ounce of time to pull all of this up today. Okay, so here we go, right from the home. Haven't done anything yet, so
yep.
Let me flip the phone around, and I'm going to try to do this one-handed, so bear with me. Okay.
So
take it away.
We walk into the Jito store. MEV powered staking rewards. You might not know what MEV powered means, but you like staking rewards. And so the stake now button is a strong one. You go there and that's going to get you your base LST. You stake Sol to receive Jito Sol. We've got a cute little animation down there to explain staking. And so I think your listeners will be familiar with staking in the abstract. So the next step, I think the more complicated thing you can do with your LST when it's Jito Sol is restaking. So if you look at the top of the page there, there's Jito top left, and then 4 or 5 options down is restaking. At the absolute top.
Oh, absolute top. Gotcha. Okay.
Yeah.
Yep.
So,
Restaking.
Yeah. So restaking. So now we're walking a little deeper into the store. We've got Jito Sol now because we've staked at that button. Now we can go to restaking. What this is going to do is here you're going to pick one of these restaking tokens, Easy Sol, Kai Sol, Frag Sol being our 3 biggest pretty significantly. And you can connect your wallet and restake there. And if you scroll down, you can have a little bit more of a explanation of what restaking is, what it does. But effectively here, you're taking your asset, which is now wrapped. You've turned your Sol into Jito Sol, and you're going to wrap it again. So when you stake it one time, what you're doing is you're securing the Solana network. You're helping to participate in making sure that the blockchain itself runs well. When you restake it, it's the same principle. You're just going one layer deeper. Instead of just helping to secure the Solana network, you're also helping to secure the Jito tip router restaking network. So you're earning rewards on 2 different forms of rewards, the staking rewards and the restaking rewards on the same core asset, which is your Sol. And so that's, again, just a little bit deeper into the store. You can stake just like you would with any other LST, but here you can earn this additional form of yield. And of course, that comes with extra risks, right?
Sure.
If there's a problem with the Solana staking contract, that's a real problem. But you're taking on risk when you stake, right? When you turn your Sol into an LST, there is a fringe risk of smart contract exploit or something. And similarly here, the trade-off for getting the initial additional yield on restaking is that you are taking on what I call that stacked protocol risk. So when you restake with Jito, there could be a problem with Jito smart contracts. When you stake with Jito, when you restake, there could be a problem with Renzo's contracts. And so it's much like any other sort of crypto activity. It is a calculation between how much rewards you're earning relative to the additional risk you're taking on.
Yeah, I want to actually drill into a couple things here. Just let me flip this bad boy around. So I think you touch on something super important, something that we focus on a lot, which is as you deepen the way that you're using these tools to your benefit,
yep,
every time yield increases by some amount, whether by, like we're talking about here, adding a new process or just using a more fringe protocol that is offering a higher APY on something, you are increasing risk.
Yep.
And the single most important thing that you can do is understand where the additional risk comes from so that you can make an informed decision about whether or not this is worth it to you. I think this is one of those areas that like DeFi gets a bad rap because of course there are different kinds of risks that we have to deal with and contend with on the DeFi side that you don't really have to on the traditional finance side, because a lot of these are startup companies like we have been talking about, right? These are new. A lot of these things are untested. These are, these require a lot more education. All the stuff that we're talking about here today requires you to learn a handful of new terms, to get familiar with a couple of different new processes and all that sort of stuff. But I think it gets a bad rap because it's not like in the traditional finance side, we're risk-free, right?
Yeah.
Like, it's not like you can, do a bunch of circular things with your money to increase yield in the traditional finance world, which you can definitely do and people do all the time, and have it be risk-free. So I just wanted to highlight for a second that as we're talking about this, it's important to understand what the risks are, but just know that these don't have to be prohibitive. You should wait until you're comfortable, but it can sound a lot more scary than it is, especially when we start throwing out a whole bunch of new jargon terms and talking about, different ways to do this. But I just think it's so important because in a world where, Andrew, I would be curious to hear your personal take on all of this, because, obviously there's something that brought you into the industry. There's some reason that you're doing this. I don't know, man, there's just like so much sketchy shit with traditional finance, especially now. I mean, we're living in like the most manipulated market we've ever seen. It makes it incredibly difficult to try and, figure out what makes sense and, where to put your attention and your money and what's worth investing in. Fear is at an all-time high and all this kind of stuff. And I don't know, like there's just something about understanding that this whole other world exists wherein you can put your money to work in a way where it's actually designed to work for you instead of just give you the impression that it's working for you.
I think that's exactly right. Yeah.
Let's zoom out for a little bit. What brought you into all this? Like how is it that you, Andrew, came to be doing this?
Yeah, I mean, very much a formative moment was probably 2008. Had good friends, family, just lives utterly destroyed. Huge chunk of my native Pittsburgh. It's really difficult to overstate like the material human suffering sort of saw and stuck with me. And so I think a lot of the Bitcoiners will say, a lot like a religion or something, you need to hear about it 6 or 7 times before it really starts to sink in. And that was just never the case with me. When I first started reading about this stuff, it was very exciting and intuitively made sense to me. Just having seen what can happen to actual people's lives when a couple of powerful individuals decide to play hanky-panky with, the global housing market and financial infrastructure. And so I think this is always what I was going to work on. And so figuring out how to help speed up its adoption was always going to be the life's work. And it was just a matter of actually getting into it. I got my first job in the industry in 2018, was working on Oracle networks at the time. They were very young. We were trying to figure out how to resell data to smart contract use cases and protocols. From there, I got recruited by Chainlink and did some business development for them leading into DeFi summer. and really saw DeFi sort of become what it is today, go from a couple 100 million to whatever we're sitting at now, 150 billion. Aave alone is 50 billion, which is mind-boggling to me.
Crazy.
Yeah, Aave is the size of a mid-sized American bank, and I don't think that trend's slowing down anytime soon.
No.
Yeah. But here at Jito, I do think that we're in a kind of interesting stage in the adoption curve where, to a certain extent, cypherpunks can almost declare victory on 80 to 90% of the original project in my mind. If you're a political dissident, a sex worker, somebody who's worrying about getting censored or debanked for whatever reason, we have created this parallel economy where you can have access to not just money, but also really rather sophisticated financial services. We did that, right? We can sort of pat ourselves on the back.
Right.
And I think the next step and a lot of the work that's happening at Jito is devoted to the last 10 to 20% of adoption, which is going to be making this parallel alternative financial infrastructure, not an alternative, but the standard. And in order for that to happen, you do need to tailor the systems, I think, to a particular user that is often seen as the bad guy in crypto, and that is these larger institutions. For them to make uncensorable, open access money and financial services the default, they need to be able to play in our playground a little bit more. And that's what, when Mert and Tolly talk about IBRL, the reason why they're doing that is not just because fast is good and it makes it really fun to use the blockchain. It's because those are the kinds of finality, speeds, and guarantees that a true international banking system and banking infrastructure provider is going to care about. In order for this to become a genuine infrastructure option for major banking providers, it needs to have certain guarantees and certain speeds, and that's really, I think, what we're focused on. That's the sort of last mile of adoption, and also the sort of focus of my and Jito's work at the moment.
That is such that's a topic that I've spent a lot of time thinking about, just, the meaningful integration of bigger players into this world. But then, of course, it comes with the battle of trying to do that in a way that doesn't compromise the D of DeFi. Because, of course, if you open up the playground for, gigantic, ultra large scale, high net worth institutional clients to come in and start doing stuff, we run the risk of accidentally centralizing anything that they touch.
Well, not even necessarily accidentally. A lot of the big stablecoin providers,
That's fair. Yeah.
Actively, they're sort of like, oh, it's cool. Look at how quickly the money can move. Look at how low the fees are. This, and wait, we can just take the treasury yield of all the stablecoins we issue. This is awesome. But then they're like, but I have to comply with OFAC. I have to comply with any sanctions that come down. So I need to be able to censor transactions. I need to be able to freeze money. I can do that, right? And I think that, my view on that stuff is that eventually the truly decentralized product wins out, because whenever somebody has a stop button, they tend to push it too much, and then users get pissed. Yeah, they will. And so I do think that even though they're coming in, that could be viewed as a sort of capitulation. That could be viewed as, that's certainly not why a lot of people got into this in the first place. And so I'm very sympathetic to that. But again, I do have this view that moving from being the alternative to the standard, which I know will be good for humanity, does mean making sure these people can participate, but making sure that they don't, compromise both the core values and the core functionality of the thing that they do, is going to be a very interesting project.
Yeah, I agree completely. I think DeFi is inevitable. It feels like the natural progression would be for, you know, institutional participant, whatever, enter, realize I need feature XYZ in order for this to do a thing. Oh, the tech exists for me to just splinter off and make this myself. I'm going to do that. And then we'll end up with this, like, you know, not DeFi permissioned ecosystem. And then you'll always have, I think, you know, in the fringes at the very least. But, you know, I would like to see it grow, the actually decentralized side of things, just because it really just comes down to realizing and opening your eyes to the fact that you're just being repeatedly taken advantage of in pretty much everything that you do all day long, anything that has to do with your money.
Yeah.
So speaking of other things to do with your money, we've talked about the idea of staking. We've talked about, you know, getting the LST and being able to do stuff with it. Some of the things that you can do with it that we haven't really gotten to focus on is obviously, you know, there's the facilitation of borrowing and lending. You know, we've talked a lot about borrowing and lending protocols. They're super popular because, you know, from the user side, the supply and earn interest is an easier concept to understand. I personally participate in that constantly with all sorts of different things. I'd like to hear a little bit more about that, just because I know that obviously, you know, we can do that too with our Jito Sol.
That's right. Again, once you've decided, you know, you want to hold Sol. Great. You want to hold Sol in a really capital efficient way, earning rewards while securing the Solana network. Awesome. You can use Jito Sol. And then even a step deeper, you want to be able to do that while earning the restaking rewards as well. You're willing to take that additional risk for that additional yield. Great. You can get Frag Sol or Easy Sol or any of the sort of restaking derivatives. From there, of course, you can do interesting things like increasing your exposure to the asset. One classic strategy is called looping. That's where you deposit something like your Jito Sol or your Frag Sol into a lending market like Camino. You then borrow against your deposit. You take out dollars, convert it into more Sol, which you then stake or restake into Jito Sol or Easy Sol, and then deposit so you can borrow more dollars. This was a popular strategy in the early days of Compound, which was at the time the preeminent lending market, Aave since taking over. But that was when Compound sort of introduced liquidity mining as a form of rewarding new deposits. Looping was a great way to earn a ton of extra yield. Today, that can be automated with a bunch of different products. Loopring is one. Camino has their own in-app looping. But if you're willing to take a lot of additional liquidation risk, and again, stacked protocol risk, I think is very, very real. If you were around during the early days of DeFi, you know, you sort of saw Cream and a lot of these other lending marketplaces that accepted these more exotic assets that had been deposited into 3 or 4 protocols. Those can get exploited. But I think if you have the right risk profile, getting a staked asset like Jito Sol or a restaked asset and then taking it to a lending marketplace is a really, really strong option, either just to lend it out and earn a little bit extra yield, or to borrow against your lending position and loop. And again, I would encourage people to look at the automated looping strategies. There's a DeFi Llama section on Solana, I think, devoted just to looping. So very easy to find those. And some of them, I think, are running points programs. So if you have any guys who are, airdrop farming, I think it's a very, very strong option.
Yeah. So this is a good opportunity for, there's a couple questions that have popped up in here. So as we're talking about, making this whole thing more intricate, let's go back to the idea of identifying, new risks.
Yeah.
How would you, kind of walk someone through a little bit more from a 30,000 foot view, analyzing what kind of new risks you're taking on by starting to do more things with an LST, especially as we talk about, looping. You mentioned a heightened liquidation risk. Of course, anytime we add in a new token to the mix, there's like you said, there's new smart contract risk to consider. There's new token specific risk to consider, especially as we add more than one token into the mix. I don't know. I guess, any advice for kind of identifying those risks and tackling them, or at least, understanding them a little bit better for someone who is newer?
Yeah, I'm by no means an expert in smart contract risk. I can
and all of us have risk tolerances that are just through the roof.
right. So, yeah, I figured this isn't the crowd where I need to hem and haw a lot, certainly. But I will say that, just I'm speaking from my own personal experience and just how I think about things. Somebody who has been a victim of hacks, somebody who's been in the protocols that got. Here's how I think about it. I do think that the age of a contract is hugely important for attempting to determine safety. The moment you deploy something on chain and it gets any significant amount of deposits, it just becomes like it's a honeypot for the smartest people in the world to try and figure out how they can exploit that code and steal that money. I think no code has ever been more secure in the history of man than Bitcoin, because it's billions and billions and billions. It's still above $1 trillion market cap, isn't it? But a huge amount of money. And if somebody figures out how to exploit it, they become immediately very rich, but nobody has. And the same sort of basic logic can apply to any DeFi protocol. The longer it's been out there, the safer it is, just because it's continued to exist and, it's become more lindy and nobody's gotten to it. Stuff like the balancer exploit a few years ago, that was their V2. I think that is incredibly rare, where a sort of older contract, you can find a problem in it. So I like older contracts, and I like having less stacked contracts. And so I don't like to go more than 3 or 4 contracts deep. Like if I take my soul, turn it into Jito Soul, I take that Jito Soul, I turned it into, Renzo restaking Soul, and then I deposit that on Camino. There's just a lot of layers of contracts that have touched that core asset, my original Soul. And, I'm happy with the yield I'm earning on that, but that's about as deep as I'm willing to go. Where, you've interacted with 4 or 5 things, you've introduced whatever edge risk each component layer has to your core asset. You've really multiplied, what was a very fringe risk into, still a very minor one, but just by nature of interacting with that many contracts, you're potentially opening yourself up to, new problems every time. So those are the 2 primary things I look at. How long has this thing been out in the wild and not gotten exploited? To a certain extent, I almost don't care about whether or not it's been audited, because the best audit is existing with a couple 100 million. Like that means that,
That's fair.
Literal Geniuses, Andin Medjedovic, the guy who did Indexed and one of the other hacks, he's a literal math genius. I think he's 20 at this point, and he hacked Indexed when he was like 18. There's a lot of other people like him. And if they've looked at this stuff and they can't steal the money over, let's call it a 12-month period, that would be a really interesting study to do. Looking at the age of every contract that's been exploited and trying to figure out, okay, if something is this old, then you're probably safe.
I could see that.
Yeah.
Yeah. What's interesting is I haven't really personally thought about like the age of a contract or like how long something has gone without getting exploited, but that's like such a, I don't know, I feel kind of dumb for not thinking about phrasing it that way before. Yeah, we talk about, watching stuff be battle tested, or I say it would be so interesting to be able to see. I vividly remember being a little kid, and my dad, who has worked in software as an engineer for a very long time and always hosted all sorts of valuable things at our house. He had his own, home network. He was running his own all this kind of stuff. And I remember one time he showed me like a live feed of hack attempts that are just kind of constantly happening and coming in.
Yeah.
And it was crazy because it was nonstop 24/7, with just a whole bunch of things running. I mean, everything from your basic dictionary hack, which is basically just, trying a gajillion password combinations to try to break through something, because most of hacking is just knowing the password to something that you're not supposed to. And then from there, getting a little bit more in the weeds, you could tell like where these different attacks were coming from. And I just remember being mind blown that like, this much effort was being put into hacking into stuff. And I think it would be so interesting to see that for crypto protocols, because I can only imagine that it's 1,000 times worse, especially as we're sitting on, protocols with, sometimes relatively thin code layers protecting millions, if not billions of dollars of like relatively high velocity assets that it would not be that hard if you got your hands on, maliciously to do. And we, of course, we see that, in every major exploit that happens, like how quick these things can go. It's very rare that one like is happening and going on and on and on and on. We can't do anything about it. It's like, yeah, that's a really good point. I'm gonna have to keep that one front of mind more often, I think.
Yeah, I think the phrase hackathon, it shouldn't apply to like building new stuff. It should just be the hackathon is everybody trying to steal all of our money all the time.
No, it's funny because before I knew what a hackathon was, that's what I naturally assumed it was the first time I heard the word. 100%. I think it's probably worth mentioning too, like if you're listening to this and you think like, okay, this is cool, but I'm a little intimidated by the conversation of the heightened risk. Let's say that, like Andrew's saying, what you're starting with is this desire to hold Solana. Okay. And we're going to stop there for a second. We just have a wallet and we want to hold some SOL because we're like, yep. Okay. For whatever reason, I believe in this thing long-term. I want to hold some of it. It's not like you would have to make the decision to then stake that entire piece. You could stake
That's
half
right.
of it.
That's right.
You're unsure. There's unlock times. There's, like we said, there's smart contract risk. There's the risk that the validator that you're delegating to could get slashed and you could get punished for being a part of that whole thing, whatever. Like, risk starts right there. Obviously, there's risk in just holding the SOL, but you don't have to go in full port with the whole thing. So if something like this sounds interesting, I mean, the way that I got started with any of this stuff was itty bitty little slice because I knew I was going to mess it up, and I did. The very first time I ever did anything like leveled up DeFi was providing liquidity with like an ETH uni pair on Uniswap back years and years ago, and screwed it up immediately. Didn't know that it required like any sort of maintenance or management. I just thought like I could stick it in there and just like earn money forever. And then of course the price of things changed and all of a sudden it was gone. And I was like, shit. Okay. Back to the drawing board. But importantly, I only started with, a little teeny bit because I was like, I have no clue what I'm doing. Let's see what happens. So, if any of this, kind of sounds interesting, I would encourage you to do some exploring on the platform. There's a tremendous amount of stuff. Up there, there's some really good reading, and if you've been listening to Andrew talk and you've heard more than a few terms that you're unfamiliar with, I hope you wrote a couple down because these are awesome rabbit holes to chase down using our AI research assistants like we've talked about, plugging in a term, letting it give you 10 more terms and letting all of those things kind of give you new areas to explore. You can have the risk conversation with these things too. Like, hey, what are all of the possible points of exploit at this with this activity? Tell me something about, tell me something that I need to be concerned about that's not in the commercial, whatever, those are great conversations to have. Especially because, like you said, if we're talking about something with a contract risk, one of the upsides to this stuff is that, a lot of this is open source, but it's not really helpful if you have no clue what the code is.
Yeah, I think I just throw out there too. I think one way to mitigate the risk is by trying new stuff in particular. Crypto does this really wonderful thing where it subsidizes experimentation for new users via airdrops. If you're interacting with stuff that has a points program going on, interacting with anything that's pre-token, whatever your sort of fat finger sloppy mistakes might be, often that can be recompensed in at least some minor form by the airdrop. I think it's a very rewarding industry. At times, you can get away with being a little bit clumsy because there is this idea that's unique to DeFi in my mind that users should be co-owners, and so interacting with new stuff before the token comes out, great way to mitigate a lot of those. Well, not necessarily mitigate, but perhaps offset is the better word. Offset some of those, making early mistakes, and we've all.
You bring up kind of exactly where I wanted to go next. Talk about part ownership. Immediately in tandem with ownership, I think comes governance.
Yes.
Can you talk a little bit about kind of what the options are and how all that works on the Jito side? Because of course.
Sure. Let's, if you don't mind, I know you have to click a lot of buttons and
no.
get your out, but let's pull up the Jito page again.
Let's do it.
But yeah, we're really proud at Jito. I think we were sort of early to realizing that the only real way this stuff is going to work in terms of governance is if the governance asset is also connected to the health and the revenues of the core protocol in some way. It's not enough that the governance token lets you control the ongoing development of the protocol. The holders of the governance token also need to benefit from its success as well. In traditional equities, this takes the form of buybacks or dividends. In crypto, only a handful of projects have gone that route, either giving rewards to token holders, governance token holders, or using protocol revenues to actively buy back the token. I think we're sort of trying to lead the charge to do that in the smartest way we can. And you can see some of that if you look at the top there, the far top, the JTO hub. JTO is Jito's governance token. Here you can see a ton of really interesting stats about the Jito Network. So we have a lot of products that are making money. We have Tip Router, we've got the block engine, we've got Jito Soul. All of that's annualized to about 18 million. We've made 25 million over the course of the life of the protocol. And you can see that sort of broken down by quarter, by product. We've tried to make this really analogous to, an earnings report for a stock. And so when you're looking at JTO, you're not just looking at, a run-of-the-mill governance token. You're looking at an asset that gives you stake in a DAO that does make money, makes significant income, has previously made a whole lot more money. When Trump and Melania were launching their meme coins, the block engine was doing extremely well. And we think that eventually there will be a catalyst to bring that kind of volume back to Solana at some point. But we're also currently working on ways to turn all of that revenue into benefits for token holders. Specifically, we're working on a lot of, within the DAO, we have a subgroup called the Crypto Economic Sub-DAO, the CSD, and they're working on an automated buyback system and currently executing manual buybacks. I believe we've done about 4 million in buybacks to date. So this is something, again, we're trying to push. We take a lot of inspiration from MakerDAO, which has done a lot of buyback stuff in the past. Aave, which just initiated a buyback. Euler do a very good job with theirs. We're trying to, be part of that broader movement underway right now to really turn governance tokens into investable assets by connecting the revenue of the protocol to the governance token. And in our case, we're doing that with a buyback.
I think it's so, one of the more recent projects that we've talked about, specifically with regards to their token and why it's unique, has been DeFi Carrot, kind of going through CRT and what makes it different from a token that you would buy with the hope that it would just skyrocket in value and you'd be able to, sell it and buy the Lambo. And I think I definitely want to focus a little bit more on just like the versatility of tokens that do stuff and, what you might want to consider before making the decision to own a token. You know, not just this idea that like, okay, I want to speculate on this flavor because I don't know, you know, pick your reason for wanting to speculate on something. So and so tweeted about it. So and so's partnering with it. You know, whatever the usual ingredients for speculative hype are. I think, you know, governance has some work to do because in general we've heard the governance shill for a long time, right? Like, you know, oh, buy this token because it gives you governance rights over XYZ, whatever it is. And okay, sounds great on paper, you know, but we were still making the attempt to sell governance as one of these hype ingredients that will drive, you know, speculative price increases. And I just think that's so unbelievably unhelpful.
It's also just like not true. I think I remember the Ethereum name search. Like you can construct in your head a kind of convoluted argument for why governance should be valuable. Like if I'm a big user of a protocol, I want to own some of the governance token to make sure I can use it in the particular way that I want to. But how much is that really worth? And so I do think that a lot of governance tokens have generally been overpriced historically to the extent that they're not, you know, if they're not generating some sort of cash flow that's being passed on to the token holder and the user, what's the point? I remember when ENS, Ethereum name service, did their airdrop. Who was it? Brantley Milligan, I think. Somebody who works over there famously said, you know, we didn't airdrop you money, we airdropped you responsibility. Nobody wants responsibility. I can't invest responsibility. I can't, like, I don't want my responsibility to be worth something. So governance, I think DAOs have a lot to figure out. How to incentivize intelligent participation in DAOs is really tough. You know, we've got a delegation program over at Jito. I think that's doing reasonably well, but we do need more organic participation. And we almost need to do away with the notion of governance tokens. They need to be, you know, bearer assets. They need to be, tokens need to start looking a whole lot more like traditional equities. Because I do think, like, when you buy a stock, what are you getting? You're supposed to be getting a fraction of ownership in the company and rights to that company's revenue, be it expressed in dividends or buybacks or future growth or what have you. From a practical perspective, often you're not getting the fractional ownership. You might be getting the dividend, but a Class A share, you're not going to be able to remove board of directors even if you own a ton.
Right.
Having assets like equities or having, you know, an asset on chain, you know, it's not an equity to the extent that it probably passes the Howey test. You're not relying on the efforts of others, so on and so forth. But it gives you rights similar to equities, such as, you know, being able to boot the founding team, being able to fund or withhold funding for a development entity, being able to change how much dividends are flowing to you. I think having smart contract-based on-chain guarantees of the things that people associate as being valuable with equities. Like there's a world in which tokens should be more valuable and should be valued at a higher premium than equities because you're going to have smart contract-based guarantees of the rights conferred by the asset. That's not happening yet, and that needs to start happening. And I'm excited for like what this is going to look like when you can start really applying price to earnings ratios to things like tokens. That's the sort of future I'm envisioning, and I think one that we're trying to push for at Jito for sure.
I mean, okay, so there's a lot there. First of all, just being able to have a genuine conversation about earnings is important. And obviously, as we talk about these things, you know, in general, there's not really a lot of revenue to discuss, you know, especially as it comes to like trying to prop up a valuation. You know, we don't value a speculative asset the same way that we would value, like you said, a stock. Wherein, okay, we're going to abide by some, you know, traditionally accepted standard of valuation based on, you know, how much revenue and, you know, future potential earnings and, you know, growth percentage and all this kind of stuff. And we just really we're just barely starting to get the ability to even have that conversation in crypto. But two, I think you make an interesting point about the governance. I mean, I've always thought the problem with governance tokens was just the incentive. So if you think about like, okay, why does the person who currently has the governance token have it? And is your expectation of their participation unrealistic based on why they have it and what they understand about what it is that they have?
Yeah.
Because no one that I know, especially back in the day, was buying any of these governance tokens because they were excited about using it to do something with. Yeah. Even if all of them would use the idea that it gives you governance rights as a shill when talking about it to other people to try to get them into it. Like it is a bumper sticker that no one gives a shit about.
Yeah.
But that's just because of a flawed incentive structure and like how we're selling these things to people. So it makes way more sense that, by participating, you earn, or you have a method to earn a governance token. And then you're going to be naturally more incentivized to actually use it for good, because you continuing to get that depends on it working well. And if you have a strong opinion about it, why wouldn't you want to share that? And then two, we're doing all this without really offering any routes to become educated enough to actually have a governing opinion about the protocol that you're supposed to be executing or exercising governance over. Like how could someone meaningfully use JTO if they had no clue what the hell you guys were doing or why this was important, or you're voting on a proposal to change X to Y, but you don't know why it was X in the first place, and you don't know why it might turn into Y in the next. There's just like so many glaring issues with the structure of a governance token that we just refuse to address, which is again another reason why I'm so excited to have you guys here. Just because, I feel, if you can't tell, I feel so strongly about this. Like, we should all care to have some of the tokens that are, governance related of the protocols that we want to use in order to free ourselves from the shackles of the traditional finance market. Yeah. You should care about that. You're allowed to care about that, and you're allowed to have an opinion. We're not constrained by the same types of things that Andrew's talking about with regards to, controlling shares and being able to have any kind of, voting power. I get, letters from the different companies that I hold stocks in every now and then, like, hey, make your voice heard, show up. And it's like, okay, really? Make my voice heard? Really? But here it's different. It's, and that's kind of the magic of it. One of the reasons why I'm sure it gets shit on a lot by traditional markets, because it's intimidating as hell. Why would you want to empower people to do more stuff? So
I think about it in terms of like, how can we make the acquisition funnel better for governance tokens, right?
Yeah.
Like we were talking about, so I walk into the Jito store. What can I do? How much deeper can I get into it? I'd like there to be a world where you walk into the JTO store because there's just an ongoing buyback. Like you walk in because the token is going up. Why is the token going up? Not because of hype, but because the protocol is programmatically buying back its own token. And this is true, funnily enough. I just used the word hype, which is why I thought of it. Hyperliquid is a great example. Like, if you don't know anything about Hyperliquid and you just look at the token's price chart, you're like, oh, it performs really strong. Maybe this is something I should buy. Then you start looking under the hood. Oh, they have a buyback. That's why it's doing this. Then you start looking at the product. Then, okay, now I hold these hype tokens. Maybe I should stake those. Then you start looking, okay, now I have stake type. There's governance? As you learn about this thing, because the asset itself is healthy, because it is routing protocol revenues back to the token in a material fashion, I think there's a world in which people arrive at wanting to participate in governance, not just out of some weird responsibility or obligation, but because they're making money and they want to continue to make money. Like we have incentives properly aligned. I think that's the sort of ideal world in which, your average investor really does show up and make their voice heard, and not just lip service that they send you on in those stock letters every now and again.
So what are the things that are the most, meaningful from your guys' perspective as the protocol that, people would be able to exercise governance over? Because I know I get, you bring up some good point. You're like, okay, so incentive. Okay, the best marketing, the best advertising that a token can possibly have is number go up.
Yes.
And hopefully then, right, the protocol is banking on the idea that they can make that happen, and that will inspire curiosity and what else I can do. But all too often we still see, token with a very high holder count, even ones that do well, and then extremely low governance participation, which of course has all sorts of other problems. Because if you build that way, where you require a certain quorum, a certain amount of the vote to be cast before you can actually make a decision, and if quorum's not met, not enough people vote, you can't move forward with the thing, even if the support that is there is overwhelming in one direction. So from your guys' perspective as the protocol, you could wave a magic wand right now, and JTO holders are, actively participating or, voicing opinions in certain aspects. What does that look like?
I mean, what are we doing wrong? Often we see the opinion of the market as expressed in the token price, right? And we try and take that as a referendum to the best that we can, but ultimately trying to figure out, maybe we should be spending less on liquidity mining. Maybe we should be buying back more. Maybe we should be doing this. Maybe we should be doing that. Having somebody who is invested enough in the token actually express those things to us directly, I think, is the most powerful thing that can happen. The foundation is the entity for which I work is beholden to the DAO. They could fire us at any moment. And instead of, not doing that, and in addition to not doing that, I think a little too often we're not hearing about what we could be doing differently. To be clear, I think we do a fabulous job. I think the fact that, the network makes as much money as it does and attempts to route that money back to the token holders, very much leading the industry in that manner. But we'll know we're really doing it right when we have enough invested holders. We've routed enough value back to the token when we do have more invested holders really trying to express to us, and invested holders, tend to be smart holders if they're sufficiently large, telling us, what we should be doing differently via the governance processes.
That makes sense. I think, I would worry a little bit as the protocol that, opinions being shared, or I guess votes being cast, would be slanted towards what people might think make number go up.
Yes.
So what, I guess, how much of a say? Okay, I'm gonna take a little walk back in time. Do you remember when Base launched? Like
Sure.
when they kind of first got started, and it was their website had a statement on the homepage, and it was very similar to kind of like when Polkadot launched. We go even further back when Polkadot launched, and there was this idea that, like, okay, we want to walk towards something decentralized, and obviously with Base we could debate that, given the fact that it's a product of a extremely centralized company and there's all that sort of stuff.
Yeah.
But the idea was like, hey, but we can't just decentralize right off the bat, which I honestly think is kind of smart. If it's open, if it's transparent, I think that's fine. We have some teaching to do before we can make like informed decision, about what to do with a token, about what to vote on, about, how to look at a proposal. So the question here from someone in the audience is just, how much of a say do token holders actually have at the end of the day when a vote is being run?
It depends on how many tokens they have. I think an incredibly base thing about governance is that if it is a kind of libertarian's wet dream, in that, you can, if you own enough of the tokens, again, you can fire me and there's nothing I can do to stop you. We have a security council that can sort of pause votes, but even that can be overridden. There's if the token holders have enough tokens, they don't need to go out and even build the coalition. a single, and this is, long been a point of criticism for DAOs. It's like, wait, isn't this, but the argument is like, what you want is somebody to come in and take over the DAO. That's actually cool if they do that. And, they're not running like a treasury liquidation strategy or something. You want somebody to take a massive controlling interest in it and shape it the way they want, because ostensibly the free market says that they'll then, do a good job and run the DAO more profitably, and then more people will come in, and whatever control they have will wane. And so I think there is a kind of hypothetical, and then there's a kind of practical. Right now, we don't have a ton of deposits from retail investors into our Realms DAO. So from that perspective, token holders don't have a ton of say. But if they want to go buy tokens, they can have a lot of say. They can completely reshape the protocol. And I think that's, when you were talking about people shilling governance tokens as assets, I think that was sort of long the dream, but that's proven to be more theoretical than borne out in actuality, except a couple like edge cases where people do, treasury raids and just strip a dying project there.
I think this kind of just makes me think of like because the comment is, okay, so whales vote, small fish don't matter. I think that could absolutely be the case. I'd be so obviously we've seen other models for this kind of thing actually. So we just went through the Octant Epoch 9 creator cohort, and Octant's voting structure utilizes some whole bunch of math that is quite frankly over my head. But one of the things that can make a big impact, not just someone who has a tremendous amount of tokens to delegate to cast a vote, but the number of voters then also voting for something matters quite a bit and can be extra, like can carry extra weight. So a structure and a methodology wherein, yes, it's true that a very large holder can cast a very powerful vote, but if one whale votes in favor of something and then 100 smaller participants, smaller holders all vote for something else, that vote can carry tremendous amount of weights too, with different kinds of voting mechanisms and voting methodologies. Is that?
Yeah, I think if you're interested in talking more of that stuff, you should have Kevin Owaki on. He sort of pioneered a lot of these weird fringe like mathy voting mechanisms over at Gitcoin. But I'm okay with inequality. I'm not okay with corruption. Like crypto, like we're very markets based. I'm okay with smaller holders not having as much of a say. I don't inherently see anything wrong with that. If you are doing something like a grant, where it's supposed to be more community based, then stuff like quadratic voting or conviction voting, or this person has been in the DAO for this long, so they get extra weight. There's like lots of ways to do it. And so for stuff that's supposed to be, again, community-based or not explicitly market-based, I think finding a way to flatten voting power makes sense. So it's closer to one person, one vote. When it comes to running a competitive entity, and Jito does have many competitors, I'm not really interested in making it easy for smaller holders to have an outside voice. That doesn't make any sense to me. I want people to be incentivized to buy the token. I want them to hold a large amount of the token, and the large holders be the one who have the say, because they're the ones with skin in the game. Of course, it makes sense that whales should have a larger say in DAO governance. Or competitive DAO governance, I should say. I think that the empowerment in this case comes from the open access and from the fact that like everything's transparent and happening on chain. I don't think we should be striving for equality of assets. I do think that it makes sense that DAO governance be unequal, because not everybody has equal stake in the economic outcomes of the DAO.
I think there's a lot of nuance in this conversation, because of course not every vote is the same. Not every, and by that I mean every proposal. Not every proposal like carries the same kind of weight. Not every proposal has the same kind of outcome. You know, DAOs can be voting on things a lot more than just, you know, because I would agree with you that, you know, in a market-based ecosystem wherein the decision at hand is also market-based and focused on competition, then yes, I as a protocol founder, owner, participant, contributor, I would want people who genuinely give a shit to be the ones that are voting with me. I think that there's room for that, for nuance in that too, wherein it's not just like, hey, I can afford to come in and buy a tremendous amount so that I can immediately have a controlling voice in a vote, but like I could also consider someone who's been methodically investing in and buying this for 5 years to also, but you know, isn't a billionaire to be able to come in, because that's kind of the danger too. Like, yes, you could say, okay, the person who has the most skin in the game, who has the most to lose, the most whatever, but it's also definitely the case, and we've seen this, where someone with a tremendous amount of wealth is happy to sacrifice some of it in order to corrupt a competitor. I mean, because nothing would theoretically stop one of Jito's competitors from just being able to say, well, I can afford to spend $15 million on sending them under to zero. I'm going to buy a controlling share and I'm going to get in there and I'm just going to wreak havoc. It's such a deep, there's no like, you know, one size fits all to the Band-Aid that patches all of the issues with governance. I think it's just like, it's a very nuanced conversation.
Yeah, I think we can fix governance tokens as an asset, like connect them to protocol revenues, either by some sort of dividend or buyback structure, before we're going to be able to fix them as actual governance assets. Like, governance is a totally unsolved problem. There's still a ton of work to do there. And I think that, we can make them investable before we make them practical when it actually comes to getting stuff done.
Yeah, and I'll let you. So here's a question from our good friend Bearded. Bearded, good to see you. Is Jito still looking to lower the quorum?
So yeah, Jito uses Realms, which is at least the most popular and probably the only. I think Jupiter built their own governance system, but by far the most popular governance platform on Solana. Realms requires a quorum, the amount of token voting power that must be reached in order for a proposal to pass, of a single whole integer, meaning we can't go lower than 1%. And so that the total circulating supply of JTO, the total supply of JTO is 1 billion, which means we need a 10 million threshold to get anything passed. And the reason why we have our delegation program is that there's just simply not enough retail deposits into Realms to get anywhere close to that 10 million threshold. And so I think we would consider lowering it if we could, but it's just not a parameter that can be changed any lower. And we've talked a little bit about internally, would we want to move away from Realms, build our own governance system? I think we talk a lot about how to get more retail participation in governance, but it's arguably the trickiest problem in all of crypto to solve. And we're still trying to figure it out.
I think with all things, the solution has to start with just education, coverage, awareness, brand building. There has to be, it's such a new concept to so many people that it just honestly, I mean, and honestly, even to me, it seems so alien. I forget all the time that I'm, able to participate in governance on different things. I've voted before. I delegated in the parachain auctions. I vividly remember watching the controversial crypto.com, the Crow vote, that obviously got swayed at the very last second. Again, exactly what we're talking about here, the ability of a couple of really large holders to be like, okay, you guys voted the way I didn't want you to. Let me press on the scale really quick. Stuff like that, I think, hurts the image of governance mattering, just because the message that sent immediately was like, it's bullshit. This is fake.
Yeah.
It's, we will let you vote and have a say as long as you do what I want you to do. Vote the way I want you to vote. Otherwise, we're going to change it. But
I think a lot of that is too, like, if you look at the structure of an IPO and then you look at the structure of how token generation events come about, another interesting study would be to try and measure how much ownership after an IPO of a traditional stock is centralized in core investors and teams versus these governance assets. I'm wondering if in crypto, a lot of the initial ownership, like these assets are still young. Like compare Aave to something like an Apple. Like Aave has, you can go out and buy ownership in a chunk of Aave right now. Apple didn't IPO for what, a decade? Aave's been around for 6 years. I think that like a lot of this is that there needs to be some natural distribution of the ownership. Like literally Stani needs to sell more. Or not Stani in particular. I'm not singling out anybody. I know the guy personally. Like I'm saying like a lot of that frustration with ownership being centralized will resolve itself over time. And that alone might solve some of these problems.
well, when you figure out how to fix,
Yeah.
all right, the hurricane siren just went off right outside my house. I've never heard them tested before. That's
spooky, and I hate that for you.
That scared the shit out of me. Don't worry, it's we're not currently getting a storm. It's very sunny. Wow, okay. I was like, oh my god, I thought that was coming from my headphones for a second. But no, hopefully you guys can't hear that because oh my god, it's deafening.
No, you're good.
Okay. It's not a test. God, I hope so. Yeah, well, Andrew, when you solve Web3 governance, let me know. I mean, I think a lot more shit has to get broken, and we have to experiment with stuff. So you guys recently had, there was I know Justin was talking a little bit about it. We haven't covered it. There was a vote. It's bearded here. I'll throw the comment up. In September, the DAO voted to have the treasury control all fees instead of being split with the labs. Do you know what the quorum was on that? Or
yeah, I can pull it up right now. That all of our delegates. So our delegate program, the foundation owns a lot of tokens, and we give the token voting power, not the tokens themselves, to people who have some sort of stake in Jito for some reason or another. That might be a validator. That might be another DeFi protocol that integrates with Jito somehow. But we have a lot of delegates in order to make sure we can achieve quorum in the DAO. And I believe all of the delegates voted yes on that. But what Bearded is asking is about how much retail participation there was. And so let me pull that up and I'll find out. But I believe it was one of the most popular because obviously it was effectively giving a lot more money to token holders instead of splitting it between labs and token holders. You can see that on Realms though. If you go to app.realms.today/DAO/Jito, or if you just go to Realms homepage and find the Jito DAO, you can find all of our voting history, and they actually do a pretty good job of visualizing that if you click through to the right stuff.
What was the, oh, I spelled the URL wrong. That'll do it. It was, would you say app.realms.today/Jito?
Yeah.
Getting a
/DAO/Jito.
Oh, gotcha. Okay, I found it. Throw this up, and then Andrew, as we start to wind down here and get ready to ride our, as we say, dogs and ponies off into the sunset, or I'll come to you here in just a second for some final thoughts, some final words of wisdom, final asks. I did want to say that it was wonderful having you here today. I'm really excited to get started on our Rum's newest partnership. So, obviously Andrew here has been, helping us dive deeper into, some more intricacies of the DeFi world, and some more things that you can do, exploring a protocol that we haven't really gotten to spend a tremendous amount of time with. But of course, the Rise Up Morning Show is now also powered by Jito, and I'm really, really excited to use this as an opportunity to just kind of launch into a whole lot more really, nitty gritty DeFi education. We're going to be able to walk through, the specific uses of a whole bunch of different pieces of this protocol, what you can do, what you might be interested in, how to identify the risks, how to decide, where you really want to be spending your time in this. Even if you're not quite ready to pull the trigger on something, I can't stress enough. I think this is so important. We're really living through a time right now where your personal sovereignty, especially digitally and financially, is really up for debate. A lot of this stuff is kind of hanging in the balance, and I truly, like, one of the reasons I wake up and do this every day is because I cannot imagine a more important thing to learn about besides this new world of, the marriage of tech and finance and decentralization. I don't know. I sound like a broken record. I think DeFi is inevitable. I think that you should know as many things as possible about this world. I think you should have experimented with it. I think you should understand how these things work. I think you should know what the terms mean, because, man, I just think every year that goes by, probably faster than that, probably every month that goes by, this is just going to become more and more important. So, Andrew, I really wanted to say thank you for spending so much time with us today. I know we ran the entire length of the show out. You've been very gracious with your time. I appreciate it. Getting to go into all this stuff. I'm excited to get you guys back. Have some more hands-on workshops and, walk through some different stuff. But thank you so much for spending your morning with us.
No, it was my pleasure. I think you guys are doing God's work, and so keep up educating your community.
I appreciate it. So let's wind down. Just help me understand exactly what I'm looking at here, and then
sure. So this is where the rubber meets the road on governance. In a lot of these, you'll see a link to our governance forum, which is hosted by the Discourse platform. But this is where people actually take their JTO tokens and go vote. Here, it's a full list of every governance action that's ever been taken on chain. And you can also see, I don't know why, we have a lot more in the treasury than $0. I guess the Realms API just decided not to work this morning. We've got at least 300 million in there, so that's frustrating. But in any case, if you want to see what the participation rates are and what the voting history is, this is the place to do it. And if you want to be, hit the back on that one. Click on JP 25. It's 3 down. Yeah. So that one has a link to the forum. And that's where the discussion about these proposals actually takes place. So if you want to talk about the proposals, I would encourage people to go to the forum. And if you actually want to vote with your JTO, this is the interface where you can do it on Realms.
Awesome. Very cool. Yeah, these are, I'll tell you right now, reading, here, I'll show you. Reading full proposals, it's dense, but this is one of those places. Oop, I rugged myself. Oh my God. There we go. We got there in the end. This is one of those places where, I mean, you can really deepen your understanding of exactly what's going on here and just get about 38 million things that you can, again, take to one of the LLMs, dig into, chase rabbits down holes, and kind of understand how much behind the scenes work is going on with all these sorts of things. Because it really gets almost no attention. I mean, we could tell, the vote threshold is low. there's not a tremendous number of votes being cast on this stuff. If this kind of thing is important to you, I encourage you to dive in and to learn a little bit more about it. And I think we can definitely, talk a little bit more about governance in the future. Just because it's not something we've spent a ton of time on. I know that's a conversation that Evan really enjoys having. Again, there is no correct answer. You can't have one size. Governance is not a one size fits all. There are so many different kinds of protocols where not everything is financial, not everything is market driven, the big difference between allocating money for the last Octon grant round versus, a proposal like this. So definitely a cool place to get a little bit more information.
Yeah, I think that's a perfect overview. I remember early days of DeFi, still remember them with a twinkle in my eye. But governance forums are a great place to find alpha. When we first proposed the fee switch, turning on the buybacks, the proposal for that was sitting in the forum for like 2 weeks before anyone noticed. And so, you can find market moving news in these outlets before a lot of other people. And so while you're 100% right, it's often incredibly dense. It's also where some of the highest signal you're going to find on not just Jito, but almost any project is actually going to be.
Well, Andrew, thanks again for spending your time. I want to turn the floor to you for your final thoughts, any words of wisdom, good jokes, final asks of our audience. The best place to find you. I've got your Twitter up here on the screen. And of course, we will be sharing a lot more, Jito specific resources in and around the community. So if you're not in the completely free to join Rise Up community, that's community.rumshq.com. If you have any lingering questions, if you don't have a question now, but you might run into one later, it's always free to toss a question in there. If there's, questions specifically for Andrew or for the protocol, let us know. We will happily forward them. This is not the only time that you guys are going to see them joining us here on the show. I'm excited to get into this. There's a tremendous amount to learn. So, Andrew, thanks again. And whatever you have to leave us with, any amusing anecdotes?
Wearing my marketer hat, I'd encourage everybody to, stake their soul with Jito, the most liquid and most decentralized LST on the Solana network. But also just want to say again, I think you guys are doing great work, and we're going to win.
Amen. Well, I appreciate you. I appreciate you being here. Thank you to everyone who hung out with us today. Tomorrow we'll be back. Actually, it's Wednesday. Tonight we'll be back. Same place, different time for Rise Up After Dark. And then again tomorrow morning, same time, same place with a little bit fuller house. Evan will be back. And if we don't see you guys tonight, we'll see you in the morning. And if we don't see you either of those places, then we will see you in the community. And with that, I hope you all have a wonderful day. Let us know if you have any lingering questions in the community, and we'll see you guys soon. There we go.